your most recent article, it really focused on some concerns about, inflation being more persistent than we previously thought. You're also focused on that most recent read on inflation with CPI. How big of a factor do you think that is for all the Fed members and for Jay Powell?
I think that they always try and play down 1 month of data, but in this case, we've actually seen CPI kind of flatline over the last 5 or 6 months. And so I think that the fact that we're not seeing the kind of progress that they had been previously enjoying when it comes to those inflation readings, that has to factor into their thinking here. They can't completely ignore the fact that inflation was coming down and that it now seems to be moving in a straight line right around 3%. And so I think, their official target, that personal consumption expenditures number, is still a little bit lower and is expected to stay below 3%, even with the recent pickup in core inflation. But I think that they've got to be at least wary that maybe the progress that they've seen, which had been so steady toward the end of last year, might be hitting a little speed bump here.
So you say wary. I think they like to say data dependent. So I want to ask you, and I asked one of our previous guests earlier today, you're looking at headline CPI, and you're saying that's showing sticky inflation. But coming up, we have PCE that we often call their preferred gauge. And generally, I think the most consensus thinking is that they're really focused on core as opposed to headline. So coming up, which was more important, the PCE coming up or the CPI that we just had?
I think they both matter in their own way. Right. I think that the PCE is the one that they officially target, but the CPI comes out in a much more timely manner. And so if they're making these decisions, I think they've got to think about what just happened with CPI, because they know based on that the PCE is likely to look a little bit firmer than it otherwise would have. And so I think both of these matter. I think those core numbers, as you referred to, those are the ones that I think they're going to be watching very closely, and particularly what they call core services. So like a measure, particularly core services ex housing, so a measure of things that are really responsive to wage increases. That core services ex housing measure has been a little bit firmer than I think anybody had expected over the last couple of months, and I think that's going to be making them a little bit nervous, because they think that's the measure they can move the dial on by cooling or slowing down the economy. Okay. And the fact that it's picking up is obviously not good news from their perspective.
All right, so we're really focused on the rate decision, but the Fed's got a lot of business to get handled in this meeting where you will be there. You're actually going to be there in the room. The other one is the FOMC rate expectations. A lot of people call that the dot plot. And also their summary of economic projections, which includes their GDP outlook. What are you expecting from that?
Yeah, I think the economic projections are going to be the really closely watched thing at this meeting. It's kind of all about the dots, because we are expecting that we might see a shift in the dots. Previously, we saw an expectation for 3 rate cuts this year. It's entirely possible that that's going to fall back to 2 rate cuts. So a slightly dialed back expectation for how much they're going to lower borrowing costs this year. I think that would be pretty notable if that happened, obviously, especially if it came alongside a sort of upgrade in how much growth we're expecting to see, and if it came alongside a downgrade in how much disinflation we're expected to see. So I think I'll be very closely watching to see what those economic projections do. And then we also, we might hear something about the balance sheet at this meeting. We know that the Fed's going to discuss it. So I think it's actually quite a lot of moving parts at this meeting.
Yeah, quite a few. And you're going to be looking, eye to eye with Jay Powell later. You're going to be in that room able to ask a question. So I want to ask you, what question, if you can tell us, if you can telegraph it to us a bit, what question do you plan to ask, or what question do you think needs to be asked, addressed, or just maybe what needs to be clarified?
Yeah, I think it depends on where I fall in the order, but I think one thing that I'm really interested in is he suggested that, the time for rate cuts is going to come soon at his congressional testimony a few weeks ago. And I want to know what that soon meant. How quickly are we talking here? And B, I want to know, why would you cut rates at a moment when inflation seems to be stubborn and growth is really solid? Like, what do you see as the risk or the threat that is so significant to the economy that it's worth taking that risk of doing it prematurely? And so I think some version of that will be my question.